So you mentioned like having proper deductions to show that your business is still generating income. What are some of those? Can you provide some examples to our attendees of the proper deductions or some of those deductions that people can make that can still show that they have income? It's not just a write-off?
I would say a small one is a retirement plan. A lot of us don't know because you've probably worked a corporate career or you probably have a working background. You know, most of us probably have not started in business. We started a corporate background. So we used to open in 401ks and different things like that with our, employer. With you being a business, you can do the same exact thing, right? Like you can open up your own 401k. You can open up a simple IRA. These things that you open up when you contribute to them are looked at as deductions or lowering your taxable income.
Welcome to the Published and Paid podcast, where we share book, business, leadership, and life lessons in 20 minutes or less to help you build a thought leadership brand and business. My name is Jasmine Womack. I'm a former middle school language arts teacher turned seven-figure entrepreneur, and I am glad that you are here. Let's get started.
There's a quote that says, you can make money two ways. Make more? What's the other way? Spend less. Not make less, spend less. Spend less. Make more or spend less. So I would love to take a moment to welcome our guest speakers. We have the Vice President of Financial Planning and Retirement Services with the Commonwealth of Atlanta. Y'all welcome Mr. Harvey Maclin. Keep clapping for him. Keep clapping till he get all the way up here. Keep clapping. Keep clapping. What's going on? All right. Looking like money. All right. And joining him, he is the CPA and CEO of Eric McGlothin, Mr. Eric McGlothin. Keep it going. All right, now you look like money too. Okay, all right. Put the backpack. You got some money in? That's a duffel bag. And of course, y'all know we can't have this fireside chat without our home girl, the Jasmine Womack.
Hey guys, always great to connect with y'all.
Yeah.
All right, so we've been working together now for about 4 years.
Yeah. Mm-hmm.
Okay, so I'm really excited. Harvey's my financial advisor. Eric is my tax strategist. We communicate on a regular basis. Yes. And I'm just now doing what they've been telling me to do for years. So, you don't want to be the difficult client. But I'm excited about our conversation today because I know that, of course, when you are published, you want to get paid, and it's important to steward and to manage your money well. And so we're going to first start off by talking about money management and tax strategy with just, some questions here. So we know that cash flow is king.
Cash is king.
And so when you have a small business who they also need to hire, what is the best way to manage cash flow and plan for hiring?
Yeah. So I think what's important, Jasmine, that's a great question, because that's usually the question, right? It's like, at what point is it too much for me, and is it time for me to hire someone? And I think it really goes to really looking at your budget or your projections. That's really what you want to do, because you want to project out, what is my revenue trending like, right? To figure out, first of all, how much revenue do I have coming in month 1, month 2, month 3, year 1, year 2, year 3, to really figure out, first of all, what's the revenue coming in? Because obviously, if you don't have the revenue to support the hire, then you're not going to be able to do it unless you borrow the money. So I think that's the first thing, to figure out what money you got coming in, and then to really figure out at what point in that period, month 5, month 6, year 1, year 2, do you have sufficient revenue to support your first hire? Because what you don't want to do is you don't want to hire somebody and then not have the money to pay them, or hire somebody and then you've got to take the money that you're going to pay yourself and you got to pay them, right? Because you got to take care of your people. You can't eat and they not eat. So that would be my advisement.
Mm-hmm. That's good. Hey, are you mic'd up? You got a mic? You have a mic on?
Is it not working?
I know. Okay, y'all good. Okay, yeah. I just want to make sure. Okay. Sorry, I didn't mean to interrupt. I want to make sure y'all are good.
Yeah.
All right. So my next question for you is a question that we often get as well, because people have a habit of commingling finances, and then when they commingle finances, of course, they can't. It makes it difficult for them to do things like buy a house or do anything financially that they need to do in life. So how should entrepreneurs approach separating their personal and business finances, and how much should be set aside for taxes? And why is this important?
That's a good question. I think working with a lot of small business owners, especially I would say first timers, that's one of the biggest things that people kind of get a mistake on. They have money coming from business revenue, but they have it coming through their personal account. In some instances, you've been told, you have to pay yourself and all these different alternatives. But when you do that and you have money from the business coming to your personal, and I know a lot of us have been told, get an LLC, protect yourself, you want to protect yourself from liabilities. The issue is if you have that business revenue that's coming to that personal account, you have pierced that corporate veil, now you're commingling. So even though you have that LLC, if someone was to sue you, they could still come after your personal assets because you got business revenue coming into your personal account, right? Now, I know some of you probably like, oh, Harvey, I already been doing that. It's okay. Stop doing it.
Right, not doing it.
Okay? Okay?
Stop doing it, right.
Stop doing it.
Right.
Once the money goes into the business account and you want to transfer it to the personal account, have at it, right? But make sure you're working with a CPA to try to understand how is the proper approach to do it. Because when you start moving money from account to account, it looks like revenue, right? So you want to have the proper reporting, right? But the biggest thing is you just want to protect yourself. You got the LLC shield, but you pierce it, that's out the door, right? And then plus, to kind of add to that, by having it separate like that, it's clean books. You have the approach where you can kind of know what your profits is, what's lost, what deductions you can take, right? Because a lot of people don't know you got the 1099 income coming in. They continue to be self-employed and don't put that LLC. You want to have that because now you could do extra deductions, right? Things that you will probably not be aware of that you could take advantage of by having that approach. That's really the main key.
And let me just add on to what Harvey has really explained very well. And I've seen this. In fact, I have a very recent client who is trying to go to the bank to get financing for his business. And because he was moving money all over the place, money between business and personal and making business revenue go into his personal account, the bank thought he was money laundering. It's too confusing. So you have to understand these financial institutions have a way that they expect to see your business revenue and expenses to come in. And when you start to defer from that or detour from that, and you start having to do a bunch of explanation, then what do they say? When you're explaining, you're losing. So you can't do that. It has to be very, like Harvey said, it needs to be very clean. I call them clean lines. So have a business account, personal account. Make sure you have, a corporate structure, LLC or an Inc., and your personal stuff. Keep them separated. I know it's hard. Listen, I know it's hard. I have 4 or 5 businesses, and whenever I'm trying to transact stuff, and the fact that I've got to move money from the business to the personal before I do something, I know it can be a mess, but it's the way to keep stuff clean and keep stuff legal so you don't have any issues.
And to make sure I answer your second question, don't over-deduct. And I know that sounds crazy. Like, you tell people and they say, write off as much as possible. Okay. Then when you go in with your financial statements, you've written off $100,000, even though you make, $175,000. You go into the bank and you say, hey, I make $175,000. They don't know. You deducted this. You only make $100,000, right? So what you want to do is you want to do the proper deductions, and then you want to work with someone that can give you advice on other ways you can deduct money but still show the proper income, right? Because some of us may not be in the situation where we probably haven't bought a home, right? You go and you think you're making all this money, but you wrote everything off. You thinking you're going to go in and say you got 100,000 in income, you only showing 25,000 in income. That's what they're going to take, okay?
That is a very, they said speak up louder, so I'm gonna speak up. That is a very real scenario. If any of you have ever in business tried to go buy a house or a car, and you know, when you come to me as a CPA, what are you telling me? I want to pay as little taxes as possible. You get upset with me when you owe $1,000. You get upset with me when you owe $10,000. Like, I didn't do my job. But the issue is, it's a matter of what income you've got coming in and what your expenses are. The last point I'll say to what Harvey was saying is, there are certain deductions that can be what they call added back when you're getting your house. Depreciation is one of those. So if you bought a car, wrote it off all in 1 year, the bank will add that back for the purpose of your income. But again, to Harvey's last point is, that is why you must have a CPA on your team to do that, because we will help you plan if you tell us this is what I'm trying to accomplish, to make sure that we're doing the right things.
So you mentioned like having proper deductions to show that your business is still generating income. What are some of those? Can you provide some examples to our attendees of proper deductions, or some of those deductions that people can make that can still show that they have income? It's not just a write-off.
I would say a small one is a retirement plan. A lot of us don't know, because you've probably worked a corporate career or you probably have a working background. You know, most of us probably have not started in business. We started a corporate background. So we used to open in 401ks and different things like that with our, employer. With you being a business, you can do the same exact thing, right? Like, you can open up your own 401k. You can open up a simple IRA. These things that you open up, when you contribute to them, are looked at as deductions or lowering your taxable income. So even though, for example, I made $100,000, I put $25,000 in this 401k, to the IRS, it looks like I made $75,000, right? But on the backside, that $25,000 is going in a retirement account for your interest. So that's less money you have to pay the IRS, more money going to you and your future.
That's good.
Yeah.
That's good.
So the point of what Harvey's saying is, again, it gets back to planning. And that's what it is. You're talking about proper deductions to take. And I don't know if I would use the word proper, because that means that there's maybe improper deductions there. But there are, and I will tell you a couple before Jasmine moves on to the next question. One is, as men, we can't write off our suits unless you have like your logo prominently displayed on it. Same thing with young ladies. If you want to write off your suit, it has to be, or your outfit, it has to be converted to a uniform. And the way to do that is to have it prominently displayed. It cannot be on the inside to not be seen. It has to be like here or somewhere where it can be seen, so it can be considered a uniform. So that's one deduction that I will tell you is improper. Another one that I've seen that may be obvious to you all, for example, is writing off like groceries. You can't do that. Writing off your personal home in its fullness, you cannot do that either. So those are common ones that I see that people try to write off. It may seem obvious to you, but individuals think that they can write those things off. So that's why you want to make sure when you're in business, because there's so many things you can write off, that's why you want to make sure you talk to a CPA.
I have questions about that clothing.
I told you what to do.
Yeah, he told me what to do. I fought him. We went back and forth. So
Okay.
like, listen,
Don't fight me, fight the IRS.
Listen, how this can't be part of the marketing budget, Eric?
Look, I see. You see how people try to blame the CPA? Like, I wrote the tax law. I don't work for the IRS. I work for you all.
Okay. So when is the right time for an entrepreneur to hire an accountant, a bookkeeper, a financial advisor? Because a lot of people, they'll just try to do all their finances themselves using software, right? So when is the right time for them to outsource it and hire a professional? And what should they look for in a financial professional to help them?
Go ahead.
I think once you start making any type of income from the business, you should start working with a CPA or accounting professional, right? Where we see most of the issues with people financially is they've waited 2-3 years and they get themselves in so much trouble, or they find themselves owing so much in taxes that it takes them out of the business, right? So as soon as you start making money, right, it's appropriate for you to start developing a relationship there. As far as an advisor, if you want someone to work with you on the business side, personally, you can work with an advisor, as long as you got income coming in. So if you got a corporate career plus a business, then you need someone to be helping you navigate this financial structure because it changes often and it changes rapidly, right? So you yourself don't have the time to really follow it enough to be in the appropriate way to be able to follow this thing to get your finances where it is. So you want to work with someone. On the business side, I would say once you start to become profitable, right? Because the advisor costs money, right? So you don't want to be working with someone and you're not making any money, right? There's really nothing they can really advise you on, right? So on the business side, whenever you become profitable.
Do you have a marker? Mm-hmm. I'm just going to use the whiteboard to write one.
Go ahead, do your thing.
There you go. We're going to use the whiteboard. Harvey loves a whiteboard. So if you ever meet with Harvey, Harvey loves a whiteboard. I just want to write these 3 things. And I have bad handwriting, so forgive me. This is the last one. You know it. At the point in time when you need to have these 3 things, you're typically going to need a CPA or an accountant to work with you because generally, right? I mean, who in here is an accountant? Right? So you may be familiar with these statements, but you may not know how to prepare them. When you go after, I know we talk a lot about financing, but the fact of the matter is when we go into business, we need capital, right? And we need to go somewhere to get that capital. And we're either going to get it from our own pockets, we're going to get it from the bank, or we're going to get it from an investor or a partner. And if we're going to do that, typically they're going to say, well, I need to understand what is your business doing? So these statements show that. Balance sheet shows your assets, liabilities, and equity. Income statement shows income coming in and out. This one right here is so important. This statement of cash flows, if you're in business and you don't have a statement of cash flow, the bank is typically going to have a problem with you because we think because we show net income on this that we're going to automatically be able to qualify. We got enough income. The bank's going to say, nah, man, nah, young lady. I want to see what's your net cash flow, meaning do you have positive cash flow? If you don't have positive cash, meaning more cash staying in the business than going out, meaning if your bank account is 0 every month, you don't have positive cash flow. You have 0 cash flow. So if you can't generate these things in business, at some point in time, you're going to probably need a CPA or an accountant to help you. But what I will say, in the beginning, there are tools to help. And we use QuickBooks. We love QuickBooks. So get QuickBooks, get FreshBooks, Wave, get something to electronically track what you got going on, because Mark Lemonis, the guy who did The Profit, who owns Camping World, said, if you don't know your numbers, you don't know your business.
Yeah. And to piggyback real quick, those 3 things, balance statement, to break it down to you, is your assets and liabilities. Your income statement, income coming in, income going out. Statement of cash flows, think of it like almost like a profit and loss statement, right? These are the things that are important to your business as far as the numbers. You don't know your numbers, you don't know your business. Because you don't know how to scale, you don't know where to go, you don't know what's next, you don't know when to get an employee. All these things matter.
Now, what tax saving strategies should entrepreneurs under $100,000 a year be aware of? We're going to do under and over.
So under, right, if you're at the very least, right, you should understand or be talking with your CPA about financial structures or legal structures. LLCs and corporations, those are set up with the Secretary of State in whatever state you're in. But understanding whether to be an S Corp versus a C Corp is a critical one, right? And a lot of people are advised off the rip to become S Corps when you're starting a business. And I will tell you in all candor, I'm being 100% transparent, I used to advise clients to just become an S Corp straight away. But it doesn't make sense necessarily, because when you're an S Corp now, and the IRS is cracking down on this, you have to have payroll. You have to have the owner on payroll. And if you don't do that, you can run into a compliance issue. So generally, if you're at 100,000, then that's what you should do. So that's one thing that you should think about. The second thing that you should think about is, like we talked about, keeping books and records. I can lay out a whole bunch of tax strategies, but if you don't know how much money you brought in, and more specifically, where that money went, we're already having a problem. If you're coming to me with a spreadsheet that says this is what my income and expenses are, that's probably not the best way to go, because you're going to forget something. Having a system, a Wave, QuickBooks, which I love, to be able to track what you got going in makes it very easy. So when it's tax time, like Jasmine does, she has her accountant working on her stuff, so all Jasmine says is, my numbers are ready. Not, I got to get them together, I got to go through my bank statements. Oh, I forgot, I spent my meals on my personal credit card, I got to get those off of there. See, you're already creating a bunch of heartache and such. And when you're in business for yourself, right, you got a plethora of things to do. Listen, Jasmine just scolded me in the back because I haven't done what I needed to do to edit some stuff from my book, but it's because I'm so like all over the place. I'm just like, I got so much going on. But that's where we are as business owners. So if you can incorporate tools, i.e. a QuickBooks or something to help you do that, you've already won half the battle for under 100,000, being able to make sure you've captured all of your deductions.
That's good. That's good. Let's take some questions. I know y'all have plenty of them. So y'all can choose.
Okay, I'll start with the young lady right here. Okay.
My question is that a lot of folks will talk about, I do consulting with business owners, and I always get the question about trust. Oh, I heard and I saw on YouTube that I can set up a trust and I can use that to get business and all that. And I try to tell them, like, no, you need to start with an LLC or whatever first, trying to jump into trust and all that. What do you have to say to that, or have you heard people having a misguidance, I guess, from YouTube people and online?
Yes. I think one of the biggest, miscalculations you can see is stuff that you hear on TikTok, right? Or Instagram, where you hear these things, you could do this and you could do that. You put your money in life insurance, it's going to come $2 million within 10 years, like all these different things, right? So a lot of that stuff is overinflated. And to piggyback on the trust situation, there are situations where trusts are needed, and there are situations where if they're set up properly, then there are advantages to it, including taxes, right? But you don't just set up a trust and think that this automatically is going to keep you away from creditors, IRS, things of that nature, right? There are two different types of trust, but there are many types of trust, but the specific ones are what we call revocable trust, irrevocable trust, right? Just to give you the basis. On a revocable trust, it means that you still have some form of control, your assets go into the trust. What it does is it keeps you out of probate. Whatever you put into the trust, whatever you spell out to the trust, it goes to whoever you want to spell it out. However you set it up, you can set it up in many different languages, many different ways, right? But having a revocable trust still puts you in the position to where creditors still can come at it because you still have control of it, right? The biggest thing with that trust is that it allows you to transition your assets appropriately, right? Now you got the flip side where it's irrevocable. That's when the trust owns it, right? You own the trust, but the trust owns the assets, right? So in other words, I no longer own these assets. So if there is someone that sue me, or if there is someone who wants to, or creditor come out of my assets, I don't own it, the trust owns it. But you have to be aware, because once you make those assets irrevocable, you cannot change them, right? So if you're working with an attorney and you're having that conversation, then there are some assets that probably should be irrevocable, and there are some assets that probably be revocable, right? Like your business, you probably won't make that irrevocable, right? Because you don't know what the next years will be. You don't know if you will want to transition it to your husband, your kids. We don't know what the future will hold, right? So you just got to understand the differences between the two. And there are many different trusts based upon what you're trying to get accomplished. The best advice is to go see an attorney, one in your state, one that's certified, not someone who says they do trust, because there are people out here who say they'll do a trust, okay? You look on them specifically, but it can be a beautiful way of transitioning your assets, and it can be a way where you can kind of, keep your assets, from liabilities and for protection.
And let me say this before we go to the next question. I'll come to you, brother. That is, I'm a CPA, but I'm not your CPA. Harvey's a financial advisor. He's not your financial advisor. Neither of us are attorneys. So please, the things that we're sharing and discussing are for informational purposes only. You should make sure you speak to your own CPA, your own financial advisor, your own attorney, to make sure that you get the advice that's specific to your situation for what you're trying to do. Go ahead.
In terms of the tools that you mentioned, like QuickBooks, FreshBooks, and Wave, which one is the most straightforward or user-friendly?
So I will tell you that QuickBooks is the one that's most popular out there. They've been out there a long time. That's what my firm uses. I think you've got to look and see which one works for you. But QuickBooks is the one that's most popular. That's out there. So if you ask me what would I recommend, I should just say go with QuickBooks. I mean, they have all these different editions, subscription model. So you just pay by the month. You can add users, add your accountant in. So that's my advice. Who's next? Young lady, and then you.
Thank you. I'm a single person LLC, and I am looking to definitely change that around. However, I also, when I was doing my business, a lot of things, well, not much, servicing my services, I received a lot of 1099s as opposed to the payment coming directly to the business name versus me coming direct to my social. And then, of course, taxes are in that. So now that I'm looking to relaunch Rebrand, I wanted to know, the question that Jasmine asked earlier was how much money to set aside for taxes. I was going to answer to that one. And then my second question is, what would you have, this is general information. I understand I have to go back, but what would you advise now, starting off to start this right?
Okay, so I will say a couple of things. Let me start with the tax rate first. So the tax rates right now go from 0 to 37% on the individual side. So it's all individual. I mean, everybody's picture is different, so it's hard for me to say a general number. Some people use 25% as a comfortable number to put aside. So if I got $1,000 in as revenue, I'm going to take $250 of that, put aside for taxes, and then I'll, at least I will have some money put aside. Let me say this other thing that's really, really important regarding taxes. That is, once you get into business for yourself, right? And even when you're on a W-2 through your S Corp, you still need to make sure that you put enough money aside for taxes. That is probably the biggest thing that we see, Harvey sees, I see when it comes into business. Partly why people go to Harvey to say, look, I owe $100,000. I need to set up a retirement account to shelter some of this. Is because you're making all this money, right? You're doing what you do, doing your business thing, but you have not made any tax payments, what they call estimated tax payments, which are due, very important dates, April 15th, June 15th, September 15th, and January 15th. 4 estimated tax payment due dates, April 15th, June 15th, September 15th, and January 15th. If you don't make those estimated tax payments, the IRS will penalize you even if you pay your taxes on April 15th when you file for not making those estimated tax payments. They want their tax money in quarters if you're not on payroll. So that's number one. So I need to make sure that you understand that. You got to talk with your CPA or your advisor because they'll help you look at your return to figure out what the percentage is that you need to set aside, but 25% is probably a good rule for the Fed. The state depends. Georgia's rate right now is like 5.39%, I think is what it is. So you could take that number and do with it what you will. The other thing that I was going to say that goes to your point that I would recommend for everyone, this is a really important one, do not have 1099 income come under your Social Security number. Do not do that. make sure it comes under your business's Fed ID number. I can do so much more tax planning. Harvey can do so much more from a financial advisor retirement side if your income comes under your business ID. That is probably the biggest thing I see. I have to tell my doctor clients that. I have to tell attorneys that. Everybody, doesn't matter what you are, let the income come under your business tax ID number. When they fill out the W-9, put your business name on there and put your business's tax ID number on there. If you just do that, you're already starting off ahead of the game in terms of what I as a CPA can do, what Harvey can do in terms of trying to help you tax plan.
And the great thing, to piggyback before we go to the next question, I'm sorry, is if you establish it that way, now you have a personal presence and you have a business presence. That's important. On the personal side, you got your personal credit, you got the personal things you do, but now you got the business side, you got the business credit, right? Two separate entities that could do almost the same things. So if you're building on the business side, now you can go get more money, you can do more financing, you can get credit under the business if that's the approach you want to do, because now it's established under the business. Then on the personal side, you have your personal stuff. So what you set up over here, if that goes belly up, it don't affect this side, right? So now you have a situation, if things don't work out, it don't take you down under on your personal side of your life.
And what Harvey's talking about is called protection of revenue streams. That's what you're doing when you make sure you keep these things siloed. I'm going to get the gentleman there and then the young lady in the back, but I just wanted to make this other point that Harvey was talking about when you talk about trust, and that is you're going to see a lot of stuff on Instagram. A lot of stuff on Facebook, a lot of stuff on YouTube about how to do different stuff. It's really important that you speak to your advisor about it, because what people don't realize is, yeah, you can set up these trusts, have multiple trusts. So you know how, I think there's one guy that makes it like your trust owns this house and then this owns this business. I mean, all this complicated stuff. Every time you set up a different entity, trust, corporation, LLC, you are adding and multiplying cost in terms of what you got to do. Cost in terms of bookkeeping, cost in terms of tax, cost in terms of compliance. If you're not prepared to multiply that cost and take care of that, then let's just stick to the simple things. It's okay. It's okay just to have a regular corporation, a regular LLC, and do your business that way without all these complex things that can happen once we are making our multiple millions of dollars that we know that we're going to make and decree it so in Jesus' name. But until then, we gotta do what we gotta do and just start off simple. So anyway, my man right there.
You mentioned earlier about co-mingling funds. I'm curious about co-mingling credit cards. So say you have a personal travel card that you like to use, airline industry, hotel industry, and you also have a business credit card. What's your recommendations around co-mingling of credit?
Don't.
Okay.
See, I have two,
Yeah.
and I'm not showing off. What I'm trying to do is I'm trying to be demonstrative. This is my personal platinum card, Amex. This is my business platinum Amex card. Yeah, this is expensive, right? This is $700 here, this is $700 here, but it's so critical, right? I'll tell you a couple of reasons real quick, and I'll let Harvey jump in as well. One is, if you don't have a relationship with Amex, you gotta get one. You gotta get one. Let me tell you why. Amex is one of the few creditors where once you have a personal relationship with them, you can multiply that thing with business credit. You can multiply it without having to have a DUNS number and all that kind of stuff. They're going to say, hey, how did you use this card? If you use your personal card real good, when I said, hey, I'm opening up my CPA practice, okay, we'll give you this card. And you know what? I opened a trucking company. I don't have that anymore. But when I did, I got Amex credit cards from them. Then I have a payroll company. I opened up Amex cards through them. The book that I did is through Level Up with Eric McGlothin. That has credit cards too with Amex. All without pulling my personal credit, all without not reporting on my credit, all without using any DUNS numbers and such. So that's my number one recommendation to you. But my number two is absolutely positively keep it different. It will make it much easier because remember, the purpose of having the business credit card, remember Harvey talked about business and personal separate, is because this doggone thing reports on my credit report every month and weighs down my credit report when I overuse it. This one, no matter how I use it, doesn't report anywhere. I got 5 of these junks. Well, actually I have 10 of these, and none of these. Only this one and my Delta one and my Hilton personal one report on my personal. This junk right here don't report nowhere. Well, it may report on Dunn's, but
think about what he's saying, right?
Yeah.
From a financial perspective, I didn't mean to cut in, because this is the perfect time to jump in. Think about what he's saying, right? You have your personal card that reports to your personal credit. You have a business card that doesn't. Think about that. So let's say you order some supplies from the business, right? And it's $20,000, and you order on the business card. But some happen, the client didn't pay, things are behind, reports are behind, you know the aging of business. If you use this personal card, that looks like $20,000 you owe on your credit report. It affects your credit. On the business side, it doesn't report to the personal side. So this is just a debt you owe that you have to pay, but it doesn't affect your credit. That's important, right? Because when we start to go into business, there are times when things are not going to go the way that you want. You know that. Someone may order 100 books from you, but it didn't come in until, it's supposed to come in October, but it didn't come in until December. Now you got this big debt on your books, right? If you use your personal card, now that's affecting and dropping your credit score every time. You use the business side, now it doesn't affect that, right? Money come in, boom, you pay it off, you're good. And then the business side, if you get the right one, don't have a credit limit. Now, that doesn't mean go crazy. They're not going to let you go crazy, right? But it doesn't have a spending limit. So the more you spend, the more they make available to you. So now this is a way where you can be building an opportunity to utilize money to help your business grow. It's almost like your own credit line.
Exactly.
If you think about it, right? Because as you're paying and the money continues to come in, that means you got more money that's available to you. So that may be a great opportunity that you could take advantage of, but money doesn't come on until late. So now you have this card to utilize to hold that stopgap until that money comes in, right? Because that's basically what you should be using a line of credit for, right? When those stopgaps, you got to pay your employees, salaries, these things that continue to hit, money's not coming in, so you got to get the money from somewhere. Some of us don't have the background in business to be able to support that. But by having this business credit card that I've been building and utilizing, I got $60,000 there. I may take that $30,000 to make that happen because I know the money's coming in. We're not making purchases if we don't know the money's coming in, because you're going to put yourself in debt. If the money is coming in, it hasn't come yet, you need to pay your employees, you need to pay your office, or whatever the case may be. You got the card to utilize, use it, get it back, continue.
And Harvey brings up a great point. I'm gonna make this last point. I'm gonna get to the young lady in the white, and that is that typically when we are when we look at the money circles, like in terms of money coming in and money going out, we want money to come in as fast as possible, right? We don't like necessarily receivables of 30 days, 60 days, 45 days. We want like, I did the work, pay me like right now, right? But when we're on a payable cycle, we want that thing to be as long as possible to make sure that we got enough time for, like Harvey said, money to come in, and then you can pay stuff off. So that's really the kind of the exchange that we want to have happen. If we're gonna use our business credit, we use it to service a purpose, and then when that money comes in, we go ahead and we pay that thing off. Young lady in the white.
I imagine this might be part of the book that you have coming out, but for now, do you have any recommended trusted books and podcasts so I can keep this information flowing around?
Your podcast?
Yes. So I do. Thanks, Jasmine. Yes. So I do. And Jasmine's working with us. So I will say, let me just say this in all candor. Yes. So yeah. So what the good thing is about what Jasmine is doing, and let me just pull out because I need to make sure that I do what Jasmine taught me, right? So I've written this book called Make Money Your Employee. You can get it on Amazon. Thank you to Jasmine who inspired me and helped me to write this book. Let me tell you, it took me 2 years to get this thing out. It is not Jasmine's fault. Jasmine had the book done in 90 days. I just had to go through the draft and stuff, and I just did not do it. So I really appreciate Jasmine for this and even her whole process. Huh?
Can you repeat your title again?
Make Money Your Employee.
It's on Amazon.
It's on
'cause I
Amazon.
put
I'll pass it around.
Amazon. So-
I'll pass it around. You can take a look at it and get the title and stuff. But I would appreciate it. And if you order the book, on Amazon or even on my website, ericmcglothin.com, let me know that you ordered it, and I'll give you a 15-minute session, and we can talk about whatever your individual questions are that may help you. Just send me the receipt if you did it on Amazon. If you do it on my website, I'll get the receipt, and I'll gladly sit with you and talk to you about that. But you asked for recommendations. So my podcast is definitely one. You can look for me on Emac CPA on Instagram and YouTube, and on Facebook is just my name. But a person I will tell you who really helped in terms of honing, like some things they think about, like in terms of write-offs and CPAs and stuff, is actually Robert Kiyosaki and the people that he had at the time, like Garrett Sutton and those folks that were helping him really shape, understanding that a house is not an asset, right? Because it doesn't generate revenue. Understanding the cash flow quadrants, which I love teaching on the cash flow quadrants, So being employed, then you're self-employed, you're a business owner, investment or investor, all those kinds of things. In terms of investments, I'm gonna let Harvey speak to what things you can do to learn about that. I will say that Earn Your Leisure is one that I follow, EYL. Those guys, just because they break it down real easy, they're kind of street with it, which I kind of like, so it's not really boring. So those are the people that I look to and that have helped me.
EYL.
Earn Your Leisure, EYL. They have a podcast, they have YouTube, they're all over.
Yeah, and on the investing side, Earn Your Leisure, like he said, or you could do Motley Fool. Motley Fool is the easy one. They kind of break it, make it simple. It's motleyfool.com. It's very simple, very easy to follow. So that's a good one. I know our time is short, but one of the biggest points I want to make where I see people drop the ball, and I know this is not a question, I want you guys to understand the difference between taxes now and taxes later, okay? This is very important because I see a lot of us drop the ball here, right? You want to make sure you're planning for the taxes now and what that looks like, because you want to put yourself in a position to where you want to give the IRS what's appropriate. The IRS states in the code it's totally fine to use things to, alleviate as long as it's under the tax code. So you want to take advantage of that. But what a lot of people drop the ball on is after you're not working, the retirement piece, right? That's very important, right? So you want to be able to sit down with someone and talk about what it is for you now, but what about when you retire? What does taxes look like? Because you're setting up all these different things. You got money going into all these different areas, but a lot of people miss that back end part on what's the best way of being able to take my money to where it won't cost me a massive tax situation. Most of us put our money in the 401k, which is appropriate, right? But if you're not, or if you don't understand how it works, on the back end, there's a lot of taxes that can come out of it, right? So you want to make sure you're sitting down and looking at, okay, how can this help me now? But then later when I start taking this money, when I probably be making less than what I'm making right now, what's the appropriate way to do it to where I can take the money where I can have most of it, because it can be done, right? You can have a lot of money, and if it's set up appropriately, you could be making a lot of money, but if it's pulled out of the right tools, it could be tax-free to you. It could be pushed out until now the age of 72. There's a certain amount you could take. So these things are appropriate, right? Because we're not retiring properly. We're making a lot of money, but we're falling around the 8 ball. We spend just as much money as any other, right? But when it comes to retirement, we're last place, and it's by a long shot, right? So we're struggling, thinking that Social Security and all these different things, it was never built to take care of you. It was only supposed to be a Band-Aid. And if you're doing this appropriately, you're making enough money, by the time you get Social Security anyway, it's taxed. Most people don't know that, right? The same money you put in, when you take it out, it's taxed again, depending on how much money you make, right? So it's very important that, you sit down now while you have the time to navigate these issues, so when you do get there, your money works hard for you, not for it. Being broke is a choice. It's that's my biggest motto.
I just got a question to both of them chose to run a 401k on their own guidance in the IRA, we want to use that to invest in some business and we consider the risk of the penalty. What's your thoughts on that?
Well, one thing you could do, what a lot of people don't know, there's this concept that's called a self-directed IRA, right? So you could take your IRA money and roll it into a self-directed IRA under the appropriate TPA, that's called a third-party administrator, who sets those up because the appropriate documents got to be filed to IRS. But by rolling that money into the self-directed IRA, the IRA is now like a business partner to you. So now that IRA can buy businesses, loan money, buy real estate, and all of that, and the IRA owns it. So now you don't have to pull funds out of it and get hit with those early withdrawal and tax penalties. Now, the key thing that's so great about that, when you use that self-directed IRA, the self-directed IRA owns that property. Let me put it in your lap. So let's say you got $500,000 in a IRA, and you roll to self-directed IRA. You go buy a $400,000 home, right? You buy it, the IRA owns it. You sell that home for $700K. You made $300,000 in profit. Typically, when you do that, you have to pay taxes on that $300,000 that year or at that point, right? You want to do it at that point because it's all interest. But the flip side, if the IRA buys it, that money goes back into the IRA. You don't have to pay taxes right now.
So it's a complicated strategy. You got to make sure you have the right folks in place. He talked about a self-directed IRA. There's also one you can do with a 401k, where the 401k basically attaches to a C Corp, and then you can run a business that way. There's companies like Guidant that do those kind of things. But here's the key thing. You got to make sure a couple of things. One is that you use somebody that knows what they're doing. Secondly, understand that this is your retirement money that you worked hard for. So you don't want to lose it. I've recommended this to clients years ago, and clients, for whatever reason, their business went under and they lost their entire retirement. So it's not necessarily a strategy I would highly recommend because you're trying to set up for the future, but it's an option. And I think that's what Harvey is trying to share. And the reason why Jasmine had us come out is there's just things that we've never heard of that our Caucasian counterparts are doing and benefiting from that we don't. So we're trying to make sure that we bring that stuff to the table, but make sure you have proper financial guidance.
Yeah. It has to be appropriate. Like, you don't want to put all your money in one basket anyway. Never do that.
One last one.
Mm-hmm. Yes, ma'am.
So you guys have been talking a lot about make sure you choose the right tax strategy. How do you do that?
I'll start there. If you're working with an advisor, if you're seeking one, the biggest thing you want to ask them is are they a fiduciary? Okay? Fiduciary. The reason why you want to ask them that is because by law, they have to do what's best for you. So they can't choose any product. They can't give you any strategy unless a normal person who's in the industry will give you that same thing, and it has to be the best for you. If not, they could be fined. They could lose their licenses. There's a lot of things there. So every advisor you meet is not a fiduciary. A fiduciary is someone who has to register with the SEC and things of that nature, right? So when you're working with them, that's the first thing you want to say, hey, are you a fiduciary? If they're not a fiduciary, doesn't mean they're bad, but they're not set under the same compliance and guidelines that someone in a fiduciary is. So now you know, if this guy jacks me off and you hear those stories about people running off with your money, then you got recourse, because then now you can file the proper paperwork because they're a fiduciary.
If you're looking for a CPA, the big things you want to understand is whether you've got someone that's going to prepare taxes or someone that's going to give you strategies. I will say that's the common thing that I have when people come to me. So when I ask them, what services do you offer and do you provide? Some people just prepare the return, and that's okay. That's what some people do. But typically, if you're in business, you're trying to say, I don't want to pay the IRS and the state all this money. So what things will you do to help me do that? For example, we do tax plans for our clients. Help them look at, are they in the right entity structure? Talk to them about how they can put their children on payroll. Talk to them about how they should be talking with Harvey. Harvey and I work together to make sure that we're putting the client in the right type of retirement account that benefits them from a tax perspective and from an investment perspective. So it's those kind of things. You just want to ask those questions to make sure that you're getting and your expectations are aligned with what they can provide. That's what I would say.
And don't miss the kids on payroll, and that's a big one, right? A lot of people don't know you can put your kids on payroll. I'm talking about 8, 9, 10 years old.
1, 2-year-old, even potentially, we just have to talk about it. We'd have to talk about it.
If you're paying them under a certain amount, their income is not taxable. Think about that. You got a kid that's 10 years old, they're doing something in the business, you're paying them $10,000, you're paying them their money, there's no taxes on their money. Strategy. Now, you still need to talk to your advisor and CPA, but this is strategy, right? Let's say, young lady, you're making $80,000, but you need more, right? You got 2 kids, you want to increase your income to 100. You may go increase your income to 100. Now you may put yourself in a different tax bracket. Strategically, you can pay each child $10,000, right? Because you are the custodian of that child, right? So the account that they have, you own it. So the $10,000 goes to them. They don't pay taxes. You could take the $10,000, do what you want. You're still making $100,000.
Are you guys limited to working with people in Georgia? Sorry.
No.
So let's just do it though. Let's give them a round of applause.
That's funny.
They're going to be hanging around. So if you'd like to speak with them individually out in the hall or out here on the patio, you can if you want to get their information and set up a meeting or whatnot. But I have a token of my appreciation here for you all. And thank you so much for taking time out to come. And let's get a picture.
Thank you, Jasmine.
You're welcome. Thank you for coming.
Yeah.
How was that? Did y'all enjoy the panels today? Yeah. All right. And so our goal here was to bring you guys a ton of value here, and give you actionable strategies that you can actually begin implementing today to move the needle. So this isn't something where, I have to wait to put this into action. No, these are things that these are decisions that you can make today. These are strategies that you can implement immediately, like getting those 2 different business cards, the personal card and the business card, clutch, right? And so we have very, very full days tomorrow and Saturday. So make sure that you take the rest of today to rest up. And that concludes our VIP sessions, everyone. So let's give yourself a round of applause.